70 points higher. Coal India is up close to 100%. BEL as well as returned to its winning ways. That's up close to 100%.
So while there is volatility expected in the near term based on certain headlines that come, certain numbers that come of the previous quarter, actually, fundamentally, India is actually positioned very well for this year.
Yeah, one of the reasons our revenues are flat on quarter basis is basically the mobile revenues were kind of flat.
I think that the volatility in the alumina prices is here to stay because of what happens in Guinea.
24,900 is what the Nifty is holding on to as of now.
We realize that this brand has the potential to be what came from other countries and became a global phenomena.
The brief intraday dip that we saw got bought into, and that's good news as far as the bulls are concerned. The bank Nifty, in fact, was the one that was significantly underperforming, but that too has recovered from the day's lowest point.
That was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Dreema. Well, Dreema, earlier this morning there was that fear that the bounce will get sold into. That actually happened in the first 10-15 minutes or so. But I'll tell you what, a couple of technical indicators suggested that maybe we're getting into a bit of an oversold zone. I'm talking about the PCR that went down to 0.65 earlier today, and that's bounced back to around 0.8. So some green on the screen, not very convincing, but I think the bulls will take it.
It's been holding with a positive bias, right? So the benchmark indices are up close to about 0.5%. The Nifty is above 24,800. The sensex has gained close to about 400 points. 81,600 is the print on the sensex. But the morning was choppy, as you can see. We started flat. We raced to about 24,950 from there. That recovery was sold into, and since then, from about 12 o'clock to about 2:30, markets have been holding steady with a gain of about 0.5%. Lots of individual stocks and sectors doing well. So top of the list today in terms of sectoral gainers is defense. The Nifty Defense Index is up 3%. Realty is having a good day. Pharma is strong across the board. The Nifty Pharma Index is up over 1%, but Cipla is higher. Sun Pharma ahead of numbers tomorrow is gaining. Apollo Hospitals is seeing buying. And then PSU banks. A lot of them are to do with the defensive names, but the Nifty CPSE index also has a gain of close to about 1%, with BEL being the star stock, not just for the day, not just for the week, but for the month. BEL up 4.5% now, and its month-to-date tally stands at 22%. Fresh record highs coming through on BEL. We'll talk more about many of these stocks, but we've got an expert waiting by.
Well, that's right. And I'll tell you what, in terms of numbers that we're going to be looking forward to, it'll have to be Indices Bank, because not just the numbers, the commentary as well as something that we're looking forward to. And that's why the stock is going into its numbers extremely nervous. So let's see what happens on that.
Last time, Abhishek was telling us it came at 340, just towards the close of market. So let's see this time.
Okay, all right. Well, let's get in Shrikant Chavan from Kotak Securities, who joins us to help us out with the closing strategies. Hi, Shrikant. Good afternoon. Good to see you win. Not such a bad day, right, Shrikant? 130 points up for the Nifty. Yesterday, the way we ended, gave you a bit of a jitter. But today, the Nifty is higher. The Nifty Bank is holding above the 20-day MA. It's pretty okay looking screen. But what would your trade be?
Yeah, absolutely. Like the way yesterday it closed and today, when it opened up with a gap, there was like a very clearly, we can say that the market has started, we can say the consolidation sort of phase. And prior to that, we saw a spectacular rally on last Thursday. So maybe we can say that it's a time-based correction that is happening. And today, after hitting the levels of 24,950, which was very close to 25,000, we again saw a sell-off in the market. So the crucial part is that the market is consolidating. And today we need to see that where the markets are closing, whether it is closing at the highest point of the day or at the lowest point of the day. But in case, because of any reason, if we see the market is closing below the level of, let's say, 24,700, then in that case, some more worries will come in the market, because then we may see the markets falling to the next important levels of 24,500 or maybe 450, where the market is having next leg of support. But broadly, I am of the view that the market is consolidating, and today's closing is extremely important for us too.
Okay, today's closing is important. What about stocks? Would you have any trading recommendations for the last hour?
Yeah, see, the best part is that when there was recovery in the market, we saw specific buying interest in those sectors where there was interest when the market was going up from the lower levels of 24,000, 23,000. So today also, when we saw buying interest, in large cap banks, defense, as well as capital market related stocks, including metals. So I think all these particular these sectors are definitely going to give some more upside. That's my view. We need to be more selective, and specifically, if we have to go through with few stocks, then in that we like Hindalco, which is around 664, 665. There I'm expecting a stock to move towards 700 plus in the near term. We also like Tata Motors, which is around some 720, 25. After very long time, the stock has broken its all important averages. So the next level to watch out for would be 825, 850. And the other stock from the defense, which we like, is Bharat Dynamics. Here the stock has crossed its previous all-time high. It is sustaining comfortably above the mark of 1800. The next level to watch out for would be 2200 based on technical. So I think, yes, we need to focus on this particular major spaces.
Okay, all right. Thanks a lot for that, Shrikant. But let's focus on the result reaction actually of the day. And that tells you that, ye dil mange mo with regard to Dixon. The numbers were good. The commentary was fairly okay as well. But the valuations are very, very expensive. And also besides that, a couple of brokerages are saying there's a bit of a slowdown in the telecom space. Maybe in fact the competition is going to ramp up as well here in India. Upasana joins us to help us out with what went wrong on Dixon. Well, Upasana, stock is now down close to around 6%.
Certainly. Now, if we talk about the Q4 numbers, the Q4 was mainly driven by company's mobile and EMS segment, and company has made a few changes in terms of its revenue mix. Now, except EMS and mobile segment, revenue contribution has decreased in companies all the three segments. And now if we talk about the FY25 revenue number, it stands at 38,860, which missed the guidance of 40,000 crore that the company was guiding for FY25. Now, largely coming to the numbers, margins were a beat, but revenue and PAT was largely in line. Now, when we talk about the volumes in the mobile segment, on sequential basis, they were also quite flat, which is why we are seeing a bit of a stress out there. Now, in terms of brokerage view, Nomura has given a buy rating on the stock with a target price of 21,202 per share. It says that the mobile ramp-up is on track across its domestic and export book, and rising value addition is likely to drive margins further going forward. CLSA has given a high conviction outperform rating on the stock with the target price 19,000 per share. It says that on the back of strong top-line growth and better margins, it expects a 45% CAGR over FY25 to FY28. Now, management joined us today morning post its results to give us an outlook for FY26. It expects a 40 to 45% revenue growth in FY26 with a 20 to 25% margin expansion. It has also guided that the revenue can more than double in the next 2 to 3 years, is what the company is eyeing on. And company anticipates that the export contribution, which is currently 5% of its sales, to continue increasing forward as the quarter passes. Now, company has also highlighted that it is in the advanced stages in closing partnership for camera modules, which is in talks since a while. And lastly, company has also highlighted that the margin expansion of 90 to 100 bips, which the brokerages are also estimating, is doable in the next 2 years. So commentary remains quite positive and numbers are largely in line. So let's see what happens ahead for Dixon.
Okay, all right. Thanks a lot for that, Upasana. Well, Prakash Diwan joins us on the show. Hi, Prakash. Good afternoon. Good to see you in. What do you make of the numbers, Prakash, and the way ahead? The problem is that, the street is saying that the operating environment itself could get tighter once the PLI expires. Then you'll have higher amount of competition that will come in there. Valuations are not very, very cheap. And in select parts, this China plus one theme seems to be gradually getting factored in, at least going by the valuations. Would you buy the stock? It's already down 6%.
Good afternoon, Nigel. So, I think the key is that fading away of the PLI impact. Whatever favorable moves that you saw in terms of its operations, they probably don't seem to be, as juicy anymore. Of course, PLI also brought in the fact that some of the margins had to be passed on to the customers. But what urgently the company would need to do, and I'm sure they are aware of that, is diversify or not depend too much on just a few segments. They've grown on the back of a couple of these, product lines, and that's kind of helped them scale up. But once you reach this kind of a massive scale, it's very difficult to be growing incrementally using the same work, right? So that's where the key is. If they get some breakthrough in that, the stock will again kind of get into a bit of a momentum. But market needs an excuse to book profits on high valuations, and this was as good as any. So I would wait for it to consolidate. There could probably be another time correction for Dixon. This is something similar to a lot of the great players of yesteryears, not in the same segment, but look at Astral Poly, went through this whole Rara days, went into a segment which didn't really pay off very well, and it had to consolidate. So it's similar. So market leaders go through this kind of evolution, and my sense is you'll have to give them time to do that. But the management sounded confident of doubling revenues, and even on this scale. So that's very encouraging. So the slightest sign of improvement in terms of product mix, there you have an opportunity to buy, but not at this point in time.
Got that. Now is not the opportunity to buy, but let's talk about JK Tyres. Big surge in the stock, 14% up. Q4 numbers are out. Sudarshan now joins in, 11% now up. Sudarshan, is it the numbers? Is it the commentary? What is it?
So for tire industry, one problem is that Q4 numbers are looking a bit dated because of the reason that internals in the last 2 months have improved significantly. So I'll give you two or three reasons. First, take a look at the crude price. In Q4 FY25, Brent crude average was somewhere around $70 per barrel. Now in Q1, it's down to around $62, $63 per barrel. Even rubber prices have seen a decline further. Now, company is saying that if you compare Q4 from Q3 of FY25, raw material costs were largely stable, but company had not taken any price increase. Now in Q1, in the last 2 months, raw material costs have fallen further, which is going to aid margin in Q1 of FY25. And all the other tire companies had said that in Q1, there will be a slight decline in the raw material cost. Real decline will be seen in Q2. So there is a probability of margin expansion for all the tire companies. Further, that's the reason you would have seen for most of the companies, while Q4 numbers were weak, but because of the outlook, especially on raw material cost, all the tire stocks after Q4 numbers had moved higher. Now for JK Tyre, another reason is Mexico business. Currently, it's very negligible, but company is saying due to no tariff on exports from Mexico to US, there will be a margin expansion there as well. Also, regarding the EV, companies saying that it has already started supplying to few companies related to EV, and it's going to be big for them in FY26. So, because of the positive outlook, we are seeing a big uptick in JK Tyre.
Prakash, you heard what Sudarshan has to say. What are your thoughts?
I just want to point out, morning when we started of the day, JK Tyre was expected to be in the red. It did start in the red, right? But nobody expected things could look up so much. So this is what happens when the past is okay, but the future is even brighter. And the management commentary, if you extrapolate that with, let's say, something like CEAT, they also mentioned about how things improved in terms of RM costs and how scaling up is happening. The same goes for JK Tyre. I think the big trigger here is going to be their ability to start getting revenue streams from the newer geography of Mexico. And there's nothing stopping it from doing it. They've already set up the unit. It's already rolling out products. It's kind of ripe for re-rating. But it's also the percentage or the contribution that comes in from EVs. Because remember, EVs have a different set of trades, a different, they're much heavier. The dead weight is slightly differently handled. So if they were able to do that, then you have another stream growing without much of competition. As in the competition also is kind of starting at the same, is starting off on the same pace. So it's not that, JK has a disadvantage to that. So my sense is if that pans out, yes. But will I be exuberant and look at buying it at 10, 11% higher today? The answer is not yet, because there's still some room to establish all of those things.
Okay, all right. Prakash, wanted your view on solar industries. But before we get to your view, let's get in Riya. She's here to revise the Q4 numbers and the key takeaways from the interaction that we had with the management earlier today as well. Riya, take it away.
Well, yes, Solar Industries reported its Q4 and FY25 numbers yesterday. For the full year FY25, they've seen a revenue growth rate of around 24%, which is below the company's guidance of around a 30% revenue growth rate. On the margin front, that has been above the guidance of 25%. Margins have come in at around 27% in FY25, up around 365 basis points over the previous year. The international business grew by around 18% over the previous year, and the FY25 defense segment revenue was up around 162% compared to FY24, but still missed the company's guidance of 1,400 to 1,500 crores of revenue, coming in at just about 1,355 crores. The order book for FY25 stands at about 17,000 crores, of which defense constitutes almost 90% to the total order book. Now, coming to the guidance for FY26, the company has said that they are going to grow their revenues at around 33% over the previous year. Defense will constitute more than 30% of the total revenues compared to the 18% contribution in the current year. Capex will be around 2,500 crores for FY26. Today, in an interaction, the company also told us that they are expecting emergency procurement order finalization to happen in the next couple of months, and they're expecting substantial order inflows on this front. For the Pinaka order, execution will start by around Q2 of FY26 or latest by October onwards, and they're expecting around 550 to 600 crores of revenue on an annualized basis from the current two variants of the Pinaka orders that they've received. As more variants come up, they are going to see a revenue of around 900 to 1,000 crores from these Pinaka orders over the next couple of years. They've also highlighted that defense is going to contribute around 40% of revenues over the next 3 years. Now, on the back of this, Antique has also upgraded the stock to a buy rating. They have a target price of around rupees 15,570 on the stock, which is an upside of around 15%. And reacting to all of this, the stock has been trading higher in today's session.
Okay, all right. Prakash, what do you make of Solar Industries? I mean, we have discussed the stock. I don't think even at one-third the price, maybe even lower than that. It saw some profiting, I recall, earlier this year, and we had Mr. Nuwal joining in on this show itself to clarify, I recall, and the stock was 8,500 rupees or thereabouts. From there, just take a look at the way the stock has done. I'm talking about February till May. But what do you make of the stock at around these levels?
No, absolutely. I mean, you're right. The levels 8,500 was where it went this time around. Of course, if you look at a 52-week high, it's even sub 8,000. But, it's a stock which has very low float, and people who own it from lower levels. As you rightly said, it's kind of moved up and had a wonderful journey. So it's very difficult for people to wanting to exit. And that's one of the reasons why you don't get enough of it. So you look at the volumes, it's hardly any volumes, and it probably, do a 8-10% very easily. Now, I'll just tell you one simple thing. Solar Industries at 115 trailing PE in spite of all these good numbers. And I really don't feel this miss is such a big issue. But the read-through from the commentary on the Pinaka rockets is very simple. Who makes these rockets and rocket launchers? It's actually L&T. So what happened is I went back to the L&T numbers and L&T commentary to figure out how much of that is already kind of actively contributing. So solar is something which is too expensive, so I've kept it aside. You want to buy it only when the market corrects and gives you that opportunity, risk reward being favorable. But the Pinaka rockets is something, the launchers are what L&T actually contributes to in a very significant way. And I don't think people have started talking about L&T in the same breath as a lot of these defense plays. So, that's the interesting part. Defense will open up so many other avenues and second order impacts that you'll probably find value somewhere else and not what's staring at in your face. So that's the kind of read through on this. But great to see the new capacities getting operational and defense becoming a big contributor for them, because they've really invested a lot of capital and resources into this. So 40% is good news, but the good news is already probably priced in at 14,000 plus.
We thought BEL also, all the good news is priced in, and yet BEL is turning out to be like Solar Industries, a gift which keeps on giving. It's up another 4%. We've had many experts pointing out that risk reward probably is not favorable. The stock may correct, valuations are too high. At these levels, 382, your thoughts on BEL?
I have a bit of a different view, and gladly, I have been talking about buying it even at 360, 350 zones, which, last week when it kind of scaled up. For the simple reason, look, the commentary is telling you that things are now going to start looking up as more units get operational. They're talking about margins in spite of the 7.5% lid that the government put on some of the contracts. There's so much more that they make, right? So The operating leverage is visible. They will start executing orders for overseas customers as well. So, it's no more PSU that's kind of just fulfilling some of the demand which compulsorily comes its way. But it has also kind of developed itself into a very market-oriented competitive business. So the BL, I fully agree, would be bought even around these levels, Rima. But solar, the upside is not too great. I mean, from 14,000, probably land up at 15 and a half or 16 or wherever in the next 12 months. But here, you could have a re-rating that could continue because the order book is much faster in terms of build-up. And you would probably see 500 levels by the time we talk about this next year and things look up. So definitely, it's a bit of a different thing. While valuations, of course, we keep talking are stretched, but given the momentum, given the demand for defense plays, this is probably the poster boy of the defense industry at this moment. So you will have to live with that high valuations for the time being, but definitely makes sense to buy it, even if you nibble into it at these levels.
Okay, all right. Very quickly, Prakash, before we let you go, any view on Gland Pharma? Actually, the numbers were a little bit of a miss, but from the lows, actually, the stock has seen a sharp recovery. And as we speak, it's up more than 4%.
I mean, so, Gland Pharma has always had this sword hanging on its head in terms of, the Foseco connection. And there's so many other things that come around it. So it's something which is very difficult to analyze or evaluate in terms of, visible growth and how you would kind of want to pay for it. So, and especially pharma, Nigel, it's such a vast, this thing. You look at some of the smaller names out there, and you have Marksons and all of these, which are chugging along so brilliantly. And without it, they're boring businesses because, they're very steady state. But you'd rather make money in that than, something which is very mercurial in terms of its price behavior.
Thank you very much for joining in. We will slip into a break. On the other side, we'll get chatting with Tushar Pradhan, Director of Hexagon Partners. Stay tuned.
You focus on the gemstone side of the story?
So I think it's really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you like that design sensibility. And that's really helped us take off.
What we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
The Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper. It's going to be very difficult for natural diamonds.
Welcome back. Well, the markets are holding with some gains, but the good news actually is that from the broader markets, there are a few more stocks that actually started advancing. So that's pretty good going out there. You have Thomas Cook that's moved to the high point of the day. As we speak, the stock, in fact, is up 18% for this week. So good up move out there. Indian hotels as well, that did see a sharp pullback. Now that as well is spiking up. Smaller name like a Trident that came out with a set of numbers that's at the bottom of the screen. Well, that as well has seen an uptick. And IDBI Bank actually been seeing a good amount of delivery-based buying. So we'll have to see how that goes. But let's get in Tushar Pradhan, Director of Hexagon Partners LLP, who joins us on the show. Hi Tushar, good afternoon. Thanks a lot for joining in. How are you feeling about the Indian markets? You know, after seeing 21,700, we have zoomed to around 25,000, 21,500 to 25,000. All of this in a matter of a few months. Earnings are yet to pick up. What would your outlook be on the headline index first, on the Nifty, for the remainder of this year? Do you think we can build onto this, or do you think we're getting a little stretched on the upside?
Yeah, it's an interesting time to take this review, Nigel. And I think what is important to understand is while the move has been very sharp, you have to remember that there were reasons for this downturn in the markets as we saw it due to geopolitical reasons, etc. So it is just not the up move, but you have to calculate, what we have done actually from the start of the year, which is not much. So I think that largely reflects or discounts the kind of flat earnings that we are likely to see for FY25. We've seen most of the results come out. I think some of them are a little mixed. But I think going forward, what is going for the market is that FY26 and then on that 27 is likely to be a very significant base impact on earnings growth. So reported earnings, in my opinion, are going to be fairly strong going into the next financial year. And we'll start to see that impact come in the first few quarters of the reporting season. So come June, when we will see the first quarter of the next year and into September, I think there's going to be a lot of momentum which will build on earnings. And that's why I'm pretty positive on the index itself going forward for the rest of the year from here.
I remember you saying that perhaps you won't be surprised if the index goes back to all-time high levels towards the second half of the year, towards the end of the year. But Tushar, in the earnings season so far, or generally, given the geopolitical shifts that we've seen, have you observed any new trends which have emerged that you'd like to highlight, which can make it to your portfolio? There is a play on it.
So, I mean, there have been some trends which we have been following for some time. So one of the things, of course, as we spoke about, has been manufacturing. Essentially, what we're talking about is 6.5% GDP growth sustained over the next 2 years. If that happens, that has a natural impact on process industries, on manufacturing, on capex in general. So I'm very positive on the capex cycle picking up in the next year or so. What the last year gave us was a little bit of an uncertainty around where the election came around and capex from the government came off a little bit. And we saw that reflected in the overall GDP numbers. But I think that is all behind us. We are also now coming to a fairly good conclusion in terms of what the yields are likely to be for some time. So the confidence that private capex has is on two counts. One is on general demand conditions, and second is the cost of debt and the cost of capex going in. I think in both terms, it looks a green signal from my perspective. Demand is likely to continue to pick up from here. And if we were to believe the GDP growth estimates, given that our interest rates are unlikely to go up from here, and as a result of which, we will have a very significant situation where it gives us a lot of impetus to think that general manufacturing, I would say central or core industries are likely to do well. And I would take a further bet in terms of Atmanirbhar, or what would you call as domestic manufacturing going forward.
Okay, all right. Well, Tushar, I wanted to ask you about, these various China plus one themes and that entire focus, that India could be a potential beneficiary. We have Dixon that came out with a set of numbers. The space clearly has a big runway, but the valuations look expensive. From this entire shift towards India, what are the themes you like? Whether it's EMS, whether it's chemicals, CDMO, what would be your topic?
I think some of those are already prevalent, and we can see them already in the valuation, as you mentioned. I think some of the new ones, which we don't yet know, are likely to come more in specialty chemicals. I would still also bet a little bit on manufacturing and engineering, because in the past, what we have come to believe that large-scale manufacturing is really not replicable in India as it exists in China today. So we all know that Chinese manufacturing is absolutely world-class, and it has a potential to mass manufacture high-quality technical, or I would say technological products at a large scale. Now, to say that India will be +1 in that area in the past used to be a question mark. And I think that is what is changing at the margin, of course, but not significantly. I would think that, going by the headline about the iPhones being manufactured in India, I think that's a signal to say that now India might look at large-scale manufacturing, not really the lower end of the manufacturing like textiles or whatever, but I think the higher end of technological manufacturing, which is mass in nature. I think that is something that we are likely to see. Now, there may not be easy listed options there, but I think if you go down the supply chain a little bit, I think there might be some interesting opportunities there. So that's something which we are really very keen to uncover. The other themes on China +1, I would think, would be reducing the concentration risk that most of the OEMs may have. So it could very well go into automotive parts, components, and even to a certain extent, electrical components, which some of the manufacturers, the MNCs, already are existing in India, and all they need to do is to just expand capacity. So I think there is a plethora of these sectors which are opened up, but we will, of course, have to wait and see which companies actually come forward, put capacity, and offer a credible China +1 opportunity.
Got that. What have you made of the banking or the broader financial earnings so far? Today, we're awaiting numbers from Indices Bank, and that's going to be watched, if there is some sort of can of worms hidden there. But when it comes to the financial sector, what are your thoughts on the earnings?
I think the whole banking and financial sector, and I'm talking largely only the lenders here, has been taken, a little bit of a backseat, if you realize, in the last, I would say, even over a one-year period. And I would think that maybe the gloom that we felt, and it began with the microfinance bubble that we got seen a little bit of a bust off. We saw large private banks struggle to grow. We saw difficulty in raising deposits for the public sector banks, etc. But I think all of that is behind us. What I do feel going forward is that the growth, again, largely dependent on the GDP estimates going forward, is likely to ensure that our banking system will have adequate capital. They do not have too much of a charge on their capital. Their book sizes are extremely healthy, one of the lowest NPL ratios that we've seen for decades. And this ability and willingness to lend has come to it. Deposit growth has picked up. So all of this really looks to me like very, very combustible powder, gunpowder as we call it. And I think all it needs is a spark of sustained demand. And I think you'll see a turnaround in lenders per se going forward. So I think all of the bad news that we see probably already is in the price. If you look at average valuations, they are now well below median, especially the private banks as well. So I think I would be fairly positive, but not really overweight here. I would wait for some select opportunities to come up.
Any view on Indices Bank? So much of bad news. Bullish argument is it's trading at XYZ as a 0.0 times book value, and then suddenly you get some negative news. What's your take?
Well, I would defer to speak anything about specific stocks. I would just say I don't know.
Okay. All right, Tushar, appreciate you joining in. We'll have those numbers out later today. And as we speak, the stock seems to have cut some of its losses. But good to hear your thoughts, Tushar. We look forward to chatting up with you rather soon. Indices Bank, though, just pull up the intraday chart. I think it was perking up a little bit. It's cut its losses. Now it's down only around 1%. And the other one that I saw, I think that moved up a little bit is Asian Paints, a rank underperformer. Last quarter's numbers were disappointing. Even Nestle India, actually, both those two have moved up to the high point of the day. Slip into a short break, come back. We'll focus on some technical trading calls. Stay with us. Welcome back. Well, there's some big news from the fashion and retail segment. Aditya Birla Fashion and Retail is expected to demerge its lifestyle business. Vinny is with us to fill us in with more details. Vinny, run us through the details. How will the entities look?
Absolutely, Nigel. So, we do have that information that, Aditya Birla Fashion is demerging that lifestyle business, but the record date for that is tomorrow. So that's going to be important because now the price discovery will happen tomorrow for the new business and the new entity which will come in place. That is Aditya Birla Lifestyle Brands. The listing date yet has to be announced for that, but the record date is going to be tomorrow. The demerger ratio is going to be in the ratio of 1:1. Now, the resulting company that will be called as Aditya Birla Lifestyle Brands, that is going to be housing Madura Fashion Lifestyle Brands. Now, what brands actually come under this is going to be one, Western wear legacy brands are there. So that is whether you look at something like a Louis Philippe, Van Heusen, Allen Solly, Peter England, Reebok, American Eagle are some of the brands that will come there. Other than that, growth brands also of the company, which are there currently with ABFRL, that will come into ABLBL. That is that Aditya Birla lifestyle business side. So that will be Reebok, American Eagle and Van Heusen Innowear. That goes into this as well. So currently, when you look at it, 85% of the revenue is coming in from these brands, which is going to be going into the lifestyle brands. Now, what will ABFRL still have? The Pantaloons business, that's going to be there. TCNS business, then they have those designer brands like Sabyasachi, Tarun Talyani, Masaba, that will still be under ABFRL. Premium brands will be there as well. And other than that, luxury retail still continues to be under ABFRL, as well as Tomorrow, which is also a brand, continues to be under ABFRL. Pantaloons currently 59% of the revenue is coming in from there, followed by ethnic wear. So that those two are important brands that will still be with ABFRL. Now, in terms of the demerger, when you're looking at it in terms of the revenue split, it's quite equal. Not much of a difference in terms of the revenue that will be there for both these companies. So just the latest numbers that we had was of Q3 FY25. Aditya Birla Lifestyle Brands is around 21,500 crores, while in terms of ABFRL, it's 22,180 crores. Now, in the recent meet that they had with analysts, they have given guidances for both these companies separately. So for Aditya Birla Lifestyle, the management is targeting a 13% revenue CAGR growth over the next 5 years. EBITDA margins also around that period is going to be 300 basis points to 11% is what they're expecting there, and a ROS of around 70% plus in FY30 for the lifestyle brand. Now, for ABFRL, the management is targeting a 20% revenue growth over the next 5 years. Margins expected in terms of an expansion to 7% versus currently, which is not doing well. It's on the negative side. So, obviously, 7% is what they're expecting there. And return on capital employed is around 18% plus by FY30 is their expectation. Now, according to Bernstein's report, the estimate in terms of SOTP valuation that will be for the stock price for tomorrow, it is expected at around 185 to 215 for Aditya Birla Lifestyle brand, while for Aditya Birla Fashion and Retail, it will be now at 80 to 105. Tomorrow is the day that we'll keep an eye out on in terms of price discovery.
Thank you very much for that. NTPC Green's numbers are up for you on your screen. The profit has jumped 233 crore versus 81 crore. In the morning, I think the stock was a bit subdued. And I remember, Hormus telling us that I think the stock was even trading below its IPO price. But post the Q4 numbers and the big jump seen in the company's profitability, the stock is now up close to about 4%. Revenues too have gone up close to about 22.5%. The issue price on NTPC Green Energy was 108. The stock is trading just shy of that level despite the up move. 108 issue price, stock is now at 107. NTPC should also come up for you on your screen because that is the promoter of NTPC Green Energy. The other one to track would be Protean eGov. It comes out with its numbers today. The stock over the last 2 days has fallen more than 20%. Q4 numbers are not going to see any impact on account of not being selected for PAN 2. But I guess once again, the street will try and quiz the management on the possible impact in the future. So Protean eGov numbers are today. Shrikant Chauhan from Kotak Securities is back with us. Shrikant, any BTST calls?
Yeah, I think all these PSU banks, they are recovering from their lows, and few commodities. There also we are seeing good amount of strength. So from the PSU bank space, we like Canara Bank, which is around 107, 108. Based on its technical formation, we can see the levels of maybe 112 or 13 on the higher side. we can keep a stop loss somewhere close to 105 for the same, because there we are seeing good amount of put writing. The other stock which we like is Hindustan Copper. It is into ban period, but broadly, if we go through with its technical pattern, I think the stock is heading for the levels of 255 or 260 in the near term. So while looking at its technical pattern and the sector specific performance, Hindustan Copper also looks good and strong at current levels.
Thank you. Let's go across now to Abhishek. He's waiting by. Abhishek, PFC, best loan growth in 39 quarters.
That's on a sequential basis. We need to mention that also. So 39 quarter high with respect to quarter-on-quarter loan growth of 7.8% that they have seen. And on a YOY basis, the 12.8% growth in terms of loans is one of the best that you are seeing in last 4 quarters. Now, asset quality is the best in last 37 quarters. So a 37 quarter low gross NP ratio of 1.94%, while net NP ratio has fallen below 0.4%. In terms of P&L momentum, there is a strong yield that they have got in this quarter, which has actually made the NII jump by 39.5% YOY and about 26% sequentially. So the yield has been strong because interest income is up 10.5% quarter-on-quarter versus the loan growth of 7.8% on a sequential basis. Other income is robust, growth of 62% YOY and about 92.5% sequentially. The provisions have remained elevated this time around at 445 crore versus 75 crore in the previous quarter. Looks like they might have used the provisions to make write-offs in the asset quality. The PAT is strong over here, growth of 23.5% YOY and about 23% sequentially. We also spoke to the management of PFC, wherein they said that they saw good loan growth in this quarter. They expect the spreads to remain in the range of about 2.5%. Clean out energy is the main area of focus for them. They cannot rule out thermal projects by government which they intend to finance. The government's strategic focus on reforming Discom is one of the key highlights. And in KSK Mahanadi, PFC's exposure is about 3,300 crores. Back to you.
Okay, all right, Abhishek. Thanks a lot for giving us that analysis. But Abhishek, this evening's going to be busy. IndusInd Bank will be reporting its numbers. What are the expectations?
Well, it may report a net loss as per the poll of various analysts that we compiled. So they have already given the business momentum, one of the weakest business momentum on a YOY basis with respect to deposits and advances in last 17 to 19 quarters. So the key thing to watch is that the net interest margin can decline both YOY and quarter-on-quarter. Kotak Securities estimate 67 bips decline YOY and 21 basis point decline quarter-on-quarter in the net interest margin. Operating profits can be weak. Again, Kotak Securities estimates 67% decline in operating profits YOY and about 63.5% sequentially. Credit costs can remain elevated. We know the MFI issue that they have reported, so credit costs can remain elevated over there. Slippages also rise quarter-on-quarter, led by microfinance sector. So Kotak Securities estimates a slippage ratio of 2.7%, up about 22 basis points on a sequential basis. Asset quality largely expected to remain stable, so there can be massive write-off. Motilal Oswal estimates gross NPA ratio at 2.4% versus 2.3% in the previous quarter. Watch out for management commentary on the new management team formation, as well as the fact that business momentum, how they see going ahead, will be a key factor to watch out for. Our poll suggests NII decline of 11.5% YOY and 9% sequentially. We are working with a loss of close to 515 crore versus PAT of about 2,350 crore in the same quarter last year and about 1,400 crore of PAT in the previous quarter. Back to you.
Okay, all right, Abhishek. Thanks a lot for that. Well, Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, joins us on the show. Hi, Sudeep. Good afternoon. Good to see you. Sudeep, first your view on IndusInd Bank. It's going to be an interesting set of numbers. But numbers aside, what's your view at these levels? Are you in the camp that believes there could be value that will emerge ultimately? Or do you say there's too many moving parts, too much of negative news flow that keeps hitting, you rather stay away?
Well, there is absolutely no doubt, Nigel, that there are too many negative news flow coming out, and that's hitting us. First, we had this Forex issue of around 2,000 crore, then the microfinance issue of about 600 crore, and I believe there are some further issues which are being investigated. So, of course, there are too many issues which have hit the bank in the recent past. But having said that, I think it's a very valuable franchise which has been created. And going forward, I think there is value emerging. Of course, you have to be a little aggressive investor if you want to take a position. But if you are I think it's worthwhile looking at this bank. Maybe just hold on, wait for the results, and if there is further correction, that probably would be the time to take position in this stock. Probably we have seen the worst as far as this bank is concerned.
Okay, all right. So probably the worst to there, but we'll wait by for the numbers. Sudeep, what about PFC? What Abhishek just spoke about? The growth levels, the loan growth actually was very, very impressive. Even on a sequential basis, it's up 7-8%. The street likes that. Your view on the stock?
Nigel, I'm absolutely, focused on buying power sector related stocks, and I've been recommending power financials for some time. I clearly can see that power financials have a significant business opportunity coming up for them. Look at the amount of expansion which, whether NTPC is talking about, Tata Power is talking about, Adani Power is talking about, and the financing requirement of this expansion cannot be met by the commercial banks. So power financials will play a significant role, and probably we are seeing just the trailer of the loan book growth at this stage. There will be significant opportunity for all the three power financials, whether it's PFC, REC, or even IREDA, to scale up their book significantly. Asset quality also has been improving. The earlier challenges which they had have been taken care of. Assets, wherever there is a challenge, it has been written off. So the books are clean. Opportunity is staring at them, and it's going to happen in the near future. Under the circumstances, I believe PFC definitely is a good buy at current levels.
Okay, got that. That's about PFC. Let's talk about the aviation sector, because India has seen an air traffic growth of 8% in the last 2 months. Vinny is here with details on the growth and the market share.
Hi, Rima. So yes, in terms of the air traffic growth that we are seeing coming in during this time, that is the month of April 2025, air traffic growth in the last 2 months has been at 8%. And this time also we've seen that growth of 8.45% in April 2025. Domestic air traffic overall is coming at around 143 lakh passengers. This is on a month-on-month basis, that 8.45% that we're talking about. Indigo's market share 64.1% versus 64% in March. In Jan 2025, it was a much higher number in terms of the when you look at it in terms of the market share for Interglobe Aviation was at around 65%. So yes, right now we're seeing a recovery coming back on the month-on-month basis. Other than that, Air India, that has also gained market share by around 50 basis points in April 2025, coming in at 27.2%. Akasa remains constant at 5%, SpiceJet 2.6% as well. So yes, this is the data that we have coming in terms of air traffic, but do not forget that today we do have Interglobe Aviation's numbers as well. Good quarters, what we're expecting coming in Q4 FY25, revenue growth of 22%, EBITDA margin somewhere at 21%, and EBITDA margin at around 25% is what we're expecting. Profits at around 1,900 crores, and yields expected to be largely flattish. 5.3 is what we're expecting the yield at. Mahakumbh is going to be a key driver for Interglobe Aviation. Crude prices have been much lower, so that will be supporting the margins of the company going forward. Commentary on that front from the company. Commentary in terms of their engines, which they are more dependent on Pratt & Whitney. What is the current scenario there, as well as outlook in terms of international market, and what is the current global scenario in terms of air traffic trends that we're seeing is going to be key to watch out for.
Thank you very much for that. Nigel, we'll have another play on India's hospitality, travel, tourism sector, and that's Hotel Leela.
Oh, yes. You met them, right? Today?
Yeah, I met them. So, there is going to be one more hotel company getting listed. You already had Indian Hotels, EIH, ITC Hotels was the last one. And now you've got Hotel Leela, and they have best-in-class margins. So their margins are 46 to 49%. While Indian Hotels, say, is, for instance, at 35%. And the difference is that Indian Hotels plays in all the categories. They have the value ones, they have the ultra luxury, they have what they call upscale. But Leela, for instance, is purely in the luxury category. Wow. So their average revenue room rent is much higher than that of peers. And I think that's one of the reasons why, their margins are also higher. And the company just last year turned profitable. So it was loss-making. And then in FY25, they clocked in a profit. And the management said the best is still ahead of the company. Management now is, of course, Brookfield owned. That's the global asset management giant. They bought the company about 5 years back. And in 5 years, the business under them, Leela has gone up by nearly 3 times growth. Sudeep, quickly come in. Now you've got Hotel Leela as well. We'll analyze it threadbare in greater detail. IPO opens on the 26th. But in the entire travel, tourism, hospitality sector, what would your pick be?
Well, definitely the hotel segment. That's what I'm pretty bullish on. We have to necessarily look at the entire hotel industry and how the opportunity in front of them exists today. The way the entire industry has shaped up and the way the opportunity has come, I believe that there is absolutely a fantastic opportunity for the hotel players, and we can look at any of them from a long-term perspective.
Okay, all right. Thanks a lot for that, Sudeep. But we have a few more queries for you. For the time being, we'll slip into a short break. As we do that, here's some good news for all our viewers. India's business news leaders, now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles. You also have financial news updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. You can simply scan the QR code that's up for you on the screen. Welcome back. We've just got 7 minutes to close of trade today. And as we speak, numbers are coming in thick and fast. So you have Minda that came out with its set of numbers. For the time being, we only have the net profit that's flashing for you on the screen. Remember, it's been one of those outperformers in a longer duration of time. But we'll wait by for the numbers. For the time being, only the net profit has shown a bit of a degrowth of close to around 7.5% or thereabouts. So we'll just hold on and wait by for some of these numbers. The revenues, though, have popped up by close to around 20%. So the top line growth continues on a higher base. The street will like that. Now we're waiting by for the margin performance. So operationally, I think on the top line at least, it doesn't look too bad. Sudeep, you want to comment on this one? Minda, it's been a big wealth creator. They seem to be growing quite well. The margins are awaited, but otherwise it's been a fairly good company. And as we know, they're not impacted with regard to this entire shift to EVs.
Absolutely. I think auto ancillary, Nigel, has been one segment which has been my favorite for quite some time. And I believe that, the impact of the conversion from IC to EV is minimum or negligible or nil for most of these players. In fact, EV offers an incremental opportunity as their component per vehicle goes up. And this is an opportunity which most of them are seizing. Minda has been a fabulous wealth creator over the years. My only challenge as far as this ancillary space is concerned is this entire tariff-related uncertainty, which may or may not hit them favorably or unfavorably. We don't know that yet. So a bit of caution at this stage till the tariff clarity comes post. Hopefully 2nd June will be better. Maybe it's better to wait till tariff clarity before we make fresh acquisition here.
This Pagets Networks, there is some news over here which came out earlier. TCS has received an advance purchase order from BSNL. And part of that order, which is to supply RAN and equipment to TCS, will be fulfilled by Pagets Networks. And the potential value of Tejas' share in this will be about 1,500 crore rupees. And that's the reason why the stock is up 3%. The news is BSNL has given an advance order to TCS, and TCS will use Pagets Networks' help in executing that order, and that is valued at about 1,525 crore rupees. Now, Sudeep, Pagets Networks has been beaten down. Even the Q4 numbers were very, very disappointing. The company reported a loss this time. Their order book came down drastically. Is there value in Pagets Networks at these levels, or it's in a void?
Well, I'm a little careful. I think they were too dependent on this BSNL or BSNL related work. And once that is running out, I think their revenues are coming down. At this stage, yes, this is a good development. They've got a part of the TCS contract, and that will keep them going for some time. But I think they need to diversify. They need to get into other large clients. Till that happens, I think I will hold on from recommending a buy in Pagets Networks.
Okay, all right. Sudeep, what about, these other couple of companies? We had Hindalco, actually. I spoke to the management, Mr. Pai, today. And in the near term, the problem is their performance has been so good that some part of the street is calling out Q4 was the peak performance. Pricing was very good. Rupee was weak. Input costs were down. And there was no big impact of the trade war. That impact will start showing off in the coming quarters. What's your view on Hindalco? And also in the commentary they mentioned, Hindalco mentioned about alumina, which is the driver for Nalco. They're saying that because of the shortage of bauxite, owing to the lack of supply in Guinea, that's what could push up alumina prices. Your view on Nalco? Because if that is the case, then Nalco will be better placed.
Absolutely, Nigel. Nalco is definitely better placed with the current shortages which is developing. And Nalco has been our favorite stock for some time. And I believe Nalco is definitely a good buy. As far as Hindalco is concerned, I think Q4 numbers were fantastic. On top of everything else you said, I think the debt reduction process which they are undergoing also is on. And that's also a very good signal. Now, the only challenge is this entire tariff scenario and how that will particularly impact Novelis. I think, the commentary which Novelis gave didn't give any future projections. And they were also talking about some major impact of this tariff war or tariff issue on their P&L quarter on quarter. So I think the uncertainty regarding the entire tariff-related developments kind of clouds the future outlook of the consolidated entity. And I'll be a little careful on Hindalco at this stage. I'm not saying whether they've reached their peak or not, but fourth quarter was definitely fantastic.
Okay, Sudeep, do stay on. For now, just counting down to today's close. The Nifty's reclaimed the 24,800 mark as it snaps a 3-day losing streak, ending with a gain of nearly 0.5%. The sensex is higher by nearly 400 points. All the sectoral indices close in the green, but the sector with the most gains include defense, 3.5% up on that, led by BEL. Realty and pharma has had a very good session. The Nifty Pharma Index ending up close to about 2%. Some of the big winners today in the large cap space, BEL right on top, Tata Steel, Cipla, Bajaj Finserv, HDFC Life, Tech Mahindra. These are stocks with gains of about 1.5–2%. And the laggards, Innocent Bank ahead of its numbers. The stock is closing exactly at that 50-day moving average, 2% down on that. And you had cuts in JSW Steel, Kotak Mahindra Bank, Coal India. Stocks are down about 1% for these.
Well, in fact, from the broader markets, plenty of stocks are moving around. Tata Tele was up 20% in trade today. Apollo Microsystems, they've done a pref issuer there. The street likes it. The stock was up. JK Tyres, started off in the red. Street liked the commentary. The stock went up. Edelweiss Financial, you had Carnelian's Vikas Kemani that bought a large chunk in yesterday's trading session. The street took note of that, and that stock, in fact, was up close to around 5% in trade. IDBI Bank as well. There are hopes that maybe, in fact, that divestment could gather pace. We'll have to wait for a confirmation. But for the time being, that stock as well did do pretty well in today's trading session. NDPC Green Energy, well, the stock goes home with a gain.